Usually when we talk about a medical diagnosis, there is this expectation of clinical precision.
Right, like it's very cut and dry.
Exactly. Like you break your arm, the x-ray shows that jagged white line, and the doctor just points and says, there it is. That's the fracture.
Yeah, it's binary. It's either broken or not broken.
It's clean. And frankly, I think it's comforting. We really like our problems to be visible and easily categorized.
Oh, absolutely. We want a clear cause and effect.
But then you step into the world of global macroeconomics and technology and geopolitics, especially looking at the landscape of mid-July 2026.
Yeah, that's where the X-ray analogy completely falls apart.
Right. Suddenly that X-ray machine is just fundamentally broken. You are looking at a diagnostic scan where the cause and the effect are, like, rarely sitting right next to each other.
They're usually on opposite sides of the planet.
Exactly. You have inflation dropping in one hemisphere, causing a defense contractor to change their CEO in another. Or you have a robotics company fighting trade tariffs while a streaming service completely rewrites its search algorithm just to appease Wall Street.
It sounds completely disconnected when you list it out like that.
It really does. But the murky, invisible tissue connecting all these things, that is exactly what we are tearing into today. We're looking at a cross-section of global data from mid-July 2026, and we want you to come along on this deep dive with us.
And the overarching reality here is pretty stark.
Yeah, the mission today is to show you how geopolitical friction and macroeconomic anxiety are acting as this evolutionary forcing function. From national defense to operating rooms all the way to your living room television, organizations are basically being forced to lean heavily into disruptive tech like robotics and AI, purely as a survival mechanism.
The interconnectedness is really what makes this exact moment in time so volatile. Because, if you try to analyze any of these sectors in a vacuum, the math simply doesn't work.
You just can't do it.
No, you have to start at the absolute highest altitude, like the global currency markets. That's the only way to understand the pressure cooker that every CEO and developer is currently operating inside.
So we're looking at the July 17th FOREX.com and BCR analyses.
Right, and specifically the euro to US dollar forecast. And you see this paradox that is honestly keeping central bankers awake at night right now.
It's fascinating. The headline data shows the U.S. dollar maintaining an incredibly dominant, strong position against the euro.
Which is weird because in a normal economic textbook scenario, currency strength is tied to interest rates, right? And interest rates are tied to inflation.
Which is where the paradox hits. Because the latest U.S. inflation numbers just came in surprisingly weak.
Yeah, they dropped.
Like both the Consumer Price Index, which tracks what everyday people, what you and I pay for goods, and the Producer Price Index, which is what manufacturers pay to create those goods, they both actually dropped.
Right. So conventional economic theory says that if inflation is finally cooling off, the Federal Reserve is going to lower interest rates.
And if interest rates drop, the yield on U.S. bonds drops.
Exactly. And investors usually flee lower yields, which should weaken the dollar, as they move their capital to currencies with higher returns.
But the dollar isn't budging. It's staying aggressively strong, completely defying all the domestic inflation data.
Because the domestic data is basically being overshadowed by a much larger, darker cloud on the horizon.
Geopolitics.
Exactly. The currency markets aren't looking at last month's CPI report. They are looking at the escalating geopolitical tensions between the United States and Iran. And crucially, they are watching crude oil hold stubbornly near $80 a barrel.
And you have to trace the mechanics of how an $80 barrel of oil completely rewrites global monetary policy. Because, energy isn't just another line item in an inflation report.
No, not at all.
It is the foundational input for the modern global economy. It's literally the baseline cost of civilization.
Let's track that physically because I think that helps. A barrel of oil isn't just gas in a car. It's the cost of the bunker fuel for the massive cargo ships moving consumer electronics across the Pacific.
Right. It's the raw petrochemical input for, like, the plastics used in medical syringes.
It's the aviation fuel for overnight logistics. So if the geopolitical tension in the Middle East spikes, say a shipping lane gets restricted or a refinery is threatened, that baseline cost surges instantly.
And that immediate surge creates this compounding effect that central banks are absolutely terrified of right now.
Yeah, because if energy prices spike, the cost of manufacturing goes up.
Manufacturers pass that cost to retailers. Retailers pass it to consumers.
And suddenly, that weak inflation report we just saw, it looks like a complete mirage. The inflation becomes what they call sticky, meaning it embeds itself deeply into the economy, regardless of consumer demand.
Which brings us to the nightmare scenario for the Federal Reserve and the European Central Bank. Stagflation.
Stagflation, yeah.
Stagnant economic growth combined with high inflation. It's the 1970s all over again.
Right. And usually a central bank fights inflation by raising rates to cool off a hot economy, or they fight a sluggish economy by lowering rates to stimulate growth. But in a stagflation scenario, the tools break.
They completely break.
Yeah.
Because if they raise rates to fight the oil-driven inflation, they crush whatever meager economic growth is left. And that triggers a deep recession.
But if they lower rates to stimulate growth, they basically throw gasoline on the inflationary fire.
This specific fear is what's dictating the current policy stalemate. The sources highlight that Federal Reserve Chair Kevin Warsh and Governor Chris Waller are refusing to flinch.
They're holding the line.
They are. They're looking at the weak CPI numbers and explicitly stating that one or two favorable reports are just not enough to justify cutting rates.
They're acting as wartime central bankers. I mean, they know that if they declare victory over inflation prematurely and then a geopolitical shock in the Middle East sends oil to $100 a barrel, they will have lost all credibility.
And all control. And across the Atlantic, European Central Bank President Christine Lagarde is staring down the exact same excruciating balancing act for her upcoming policy meetings next week. Okay, let's unpack this with a visual. The best way to visualize the Federal Reserve's current predicament is to imagine you're driving a massive freight truck down a really steep mountain.
Okay, I like this.
So you have one foot hovering over the brake pedal because you see the speedometer, which represents base domestic inflation, finally starting to tick down. You want to ease off the brake.
Right, things are slowing down naturally.
But your other foot is suddenly being forced to slam down on the gas pedal because these external geopolitical oil spikes are accelerating your underlying momentum out of nowhere. You're trying to achieve a soft landing, but global conflicts keep pushing the accelerator.
What's fascinating here is that in that environment of extreme uncertainty, global capital just seeks a bunker. I mean, investors don't want risk when they don't know what energy prices will be next month.
Obviously not.
They want liquidity and safety. And historically, the ultimate safe haven is the US dollar. So that geopolitical anxiety is acting as a massive gravitational pull, keeping the dollar exceptionally strong despite the domestic metrics that suggest it should weaken.
Global monetary policy is effectively being held hostage by Middle Eastern friction.
Completely held hostage.
And if that intense baseline anxiety is the water that the global economy is swimming in right now, it completely reframes how we look at corporate behavior. We aren't just talking about abstract currency yields anymore. We are talking about physical security and logistical survival.
Yeah, the real world impact.
Right. And that structural shift is immediately visible when you look at the organizations tasked with managing that exact friction. Take ASRC Federal, for example. We're looking at a July press release announcing a major changing of the guard. Mike Manzo has been named the new president and CEO, succeeding Jennifer Felix.
Now, a leadership change at a defense contractor might seem like standard corporate housekeeping to most people. But you really have to read the subtext of the resume here.
Right, because to contextualize this, ASRC Federal is not some niche player.
Not at all. They are a sprawling apparatus. They serve over 30 different United States government agencies.
We are talking about managing space exploration missions for NASA,
Securing critical cyber infrastructure for the Department of Defense?
maintaining military base operations,
Yeah.
and handling massive, complex IT modernization projects across the entire federal government.
There is also a very unique corporate DNA here that shapes their risk profile. ASRC Federal is an Alaska native-owned company.
Yes, this is a huge point.
They financially support 14,000 Iñupiaq shareholders living on Alaska's North Slope. This isn't just about, quarterly earnings calls with Wall Street hedge funds. Since their inception, they have paid out over $2 billion in dividends back to that community.
Wow, $2 billion.
Yeah, their operational stability directly funds healthcare, education, and infrastructure for an entire indigenous population.
Which means the mandate for the CEO is incredibly complex.
Right.
You have to maintain absolute operational perfection on multi-billion-dollar federal contracts, while also ensuring consistent economic returns for a highly localized, dependent shareholder base.
Exactly. And under Jennifer Felix, who had a 7-year run 6 of those as CEO, the company saw significant growth. She navigated the chaotic post-pandemic landscape really well. But the appointment of Mike Manzo signals a distinct pivot in what the board believes the immediate future requires.
Let's break down Manzo's background, because honestly, it tells you exactly what the defense industry is bracing for.
It's all in the resume.
He has over 30 years of experience, heavily concentrated in operations. He was an executive at General Dynamics, which is a legacy titan of the defense world, where he worked directly with the intelligence community.
Right.
But most importantly, right before getting the top job, he was running ASRC, Federal's Defense and Intelligence Operating Group.
And that internal promotion is the key indicator here. Because in times of relative peace or, theoretical expansion, defense contractors often elevate visionaries or financial engineers or merger and acquisition specialists to the CEO role.
Sure, people who can consolidate the market and boost the stock price.
Exactly. But when the global macro environment is flashing red, when you have currency volatility, inflation threats, and active kinetic conflicts, you do not promote a financial engineer.
You elevate a wartime operations specialist.
Yes. You put the person who actually understands the plumbing of the intelligence community in charge.
Now, I have to push back a little here on behalf of you, the listener, because why should you care about a boardroom shuffle at a defense contractor? I mean, it sounds dry. But looking at their stated capabilities completely redefines what a defense contractor actually does in 2026.
That's a great point.
Because if you asked a random person on the street what a defense contractor builds, they'll say, like fighter jets, missiles, or tanks. But ASRC's core focus areas highlight IT modernization and supply chain management.
The modern battlefield isn't just contested airspace anymore. It's the invisible infrastructure that allows the military to function at all.
Right. IT modernization for the federal government is arguably a more pressing national security issue right now than building a new aircraft carrier.
I would absolutely agree with that. You have massive government agencies with fragmented networks. In an era of state-sponsored cyber warfare, where a single breach can paralyze a supply chain or expose intelligence assets, securing and modernizing that digital infrastructure is paramount.
A defense contractor today is essentially a massive, highly militarized cybersecurity and logistics firm.
And that second phrase you mentioned, supply chain management, that is the true silent battlefield of 2026. If you can't guarantee the physical delivery of microchips or raw materials or specialized hardware because a geopolitical rival controls the shipping lanes or the manufacturing hubs, your military is paralyzed.
The logistical friction we discussed with oil and inflation is actively rewriting defense strategy.
It forces a localization of resources. You have to map out every single dependency. Where is the silicon sourced? Where is the software compiled? If tension with China escalates, or if the Middle East disrupts global shipping, can ASRC Federal still fulfill a critical NASA contract?
Elevating a 30-year defense and intelligence operations veteran to CEO is just a direct acknowledgement that navigating those fractured global supply chains is now the primary job of defense leadership.
But the terrifying reality is that the supply chain vulnerability isn't confined to classified government projects. The exact same logistical friction that is crippling the Pentagon's planners is currently taxing the operating rooms of civilian hospitals.
It's crazy how it bleeds over. The macro anxiety doesn't respect the boundary between military and medical at all.
Not even a little bit.
You can see this vividly in the Q2 2026 earnings report from Intuitive Surgical. Now, Intuitive Surgical is the undisputed pioneer and current titan of robotic-assisted surgery. Their Da Vinci surgical systems basically fundamentally altered how minimally invasive procedures are performed globally.
And if you strictly read the headline numbers from their July 16th report, you would honestly think they are completely immune to all the macroeconomic chaos we've been discussing.
The top-line growth is staggering. Especially for a company at this stage of maturity. Q2 revenue came in at $2.89 billion.
Wow.
Which is a 19% increase year over year, and the actual utilization of their machines is surging. Worldwide procedures grew 16%. Procedures using their flagship Da Vinci systems were up 15%, and their ion endoluminal procedures, which doctors use for highly precise, minimally invasive lung biopsies, that spiked by an incredible 36%.
And to understand the physical footprint of that growth, they placed 468 Da Vinci systems into hospitals just in the single quarter, up from 395 in the same quarter the previous year.
That's a lot of robots.
Yeah, and more than half of those 246 systems were their newest, most advanced Da Vinci 5 models. So they have methodically built an installed base of 11,710 Da Vinci robots operating globally.
That is 11,710 multi-million-dollar robotic ecosystems embedded into the daily workflow of surgeons around the planet. It is one of the deepest, most impenetrable technological moats in modern business.
Because once a hospital trains its surgical staff on a Da Vinci interface, they do not switch to a competitor. The switching costs are just too high.
Right. Yet, despite that monopolistic dominance, the underlying financial metrics reveal the exact same geopolitical bruising we saw in the currency markets.
Yeah, this is where you have to look under the hood. When Intuitive's CFO issued the forward-looking guidance for the full year of 2026, they projected a non-GAAP gross profit margin of 68.0% to 69.0%.
Let's pause and unpack the mechanics of that metric, because non-GAAP is where companies hide, or in this case, expose the messy reality of their operations.
GAAP stands for Generally Accepted Accounting Principles. It's the standardized legal way you have to report your math.
Right, and non-GAAP allows a company to strip out one-time costs or unusual expenses to show Wall Street what their quote-unquote core operating margin looks like.
And in Intuitive's case, their non-GAAP projection explicitly accounts for a direct 1.0% adverse impact on revenue purely due to global tariffs.
1% might sound negligible to a layperson, but on a multi-billion-dollar revenue run rate, you are talking about tens of millions of dollars of pure profit just evaporating at international borders. Here's where it gets really interesting. To understand why tariffs hit them so hard, you have to look at the anatomy of their business model. The best analogy for Intuitive Surgical isn't a medical device company. It's a high-end commercial espresso machine.
Oh, the razor and blade model.
Exactly. They sell the Da Vinci 5 robotic system to a hospital. That's the expensive espresso machine. It requires a massive upfront capital expenditure. But the real, consistent, predictable revenue engine of the company comes from the disposable instruments and accessories that must be used during every single surgery.
Those are the coffee pods.
Those are the pods. Because of the strict sterilization and safety protocols of robotic surgery, a hospital cannot endlessly reuse the surgical arms, the graspers, or the specialized cutting tools.
No, they have a finite lifespan, which is often tracked digitally by the machine itself, and they must be constantly replenished.
And the numbers prove it. Out of that $2.89 billion in Q2 revenue, a staggering $1.73 billion came exclusively from instruments and accessories.
The coffee pods generate the lion's share of the cash.
They do. But here's the vulnerability. Those highly profitable accessories require an incredibly complex, globally fragmented supply chain to manufacture.
Yeah, the sourcing documents indicate that Intuitive manufactures a significant majority of these critical instruments in Mexico. They manufacture a majority of their highly complex endoscopes in Germany. And crucially, they import essential raw materials and electronic components from China.
So you have a physical piece of surgical steel that starts as raw material in China, gets shipped to Germany for optical integration, gets sent to Mexico for final assembly, and then gets imported into the United States to be used in a hospital in Ohio.
And at every single border crossing, geopolitical friction acts as a tax. When the U.S. and China engage in a trade war, the materials coming out of Shenzhen get hit with tariffs. That cost absorbs the profit margin of the final surgical instrument.
The company is aggressively fighting this on the legal front, though. The earnings report notes they actually secured a $28 million tax benefit this quarter from refunds on tariffs they had previously paid under the International Emergency Economic Powers Act, or IEPA.
The IEPA is a fascinating piece of legislation. It was originally designed to give the president broad authority to regulate commerce in response to unusual and extraordinary threats to the United States, essentially economic warfare.
The fact that a company building life-saving surgical robots has a dedicated legal team fighting to claw back $28 million under an emergency economic warfare statute. I mean, it shows just how deeply geopolitics has infected standard corporate operations.
And Intuitive isn't just absorbing this pain on the supply side. They are having to re-engineer how they sell to hospitals because the hospitals are feeling the exact same macroeconomic squeeze.
Because of inflation.
Right. If inflation is driving up the cost of labor and supplies for a hospital network, they're going to freeze their capital expenditure budgets. They simply won't write a check for a new Da Vinci 5.
Which would kill Intuitive's growth engine.
Yeah.
I mean, if you can't place the espresso machine, you can't sell the coffee pods.
So Intuitive relies heavily on financial engineering, and I find this part super fascinating, specifically usage-based operating leases. Out of the 468 systems placed this quarter, 254 were under operating lease arrangements, and 131 of those were specifically usage-based leases.
The mechanics of a usage-based lease completely alter the hospital's balance sheet. Instead of treating the robot as a massive, multi-million-dollar piece of owned property, a CapEx or capital expenditure,
Hmm.
the hospital essentially rents it. They pay a variable fee based on how many surgeries they actually perform with it that month.
It transforms a massive upfront risk into a flexible operating expense, or OpEx. It perfectly aligns the risk. The hospital only pays when the machine is generating revenue via surgical billing.
That's brilliant.
It really is. By removing the capital hurdle, Intuitive keeps placing machines and keeps expanding their coffee pod ecosystem, entirely bypassing the hospital's inflation-driven budget freezes.
But the overarching takeaway remains. A company with 11,000 surgical robots, absolute market dominance, and 19% revenue growth is still fundamentally constrained by trade wars, tariffs, and global inflation.
Because physical hardware is bound by physical borders, which makes it an easy target for tariffs. But the geopolitical friction we're tracking doesn't stop at the border.
No, it just shifts.
It simply moves into the digital realm where the supply chains are made of data and the weapons are mathematical algorithms.
Which leads us directly into the software layer, specifically the absolute arms race occurring in global artificial intelligence. We are looking at a mid-July report from TechRadar detailing a shockwave in the AI community.
The narrative for the last several years has been one of American hegemony in frontier AI models. OpenAI, Anthropic, Google, and Meta have largely dictated the pace of development, creating massive, highly capable models that the rest of the world scrambled to catch up with.
But this report details the launch of Kimi K3, an AI model developed by a Chinese startup named Moonshot. And the underlying architecture of Kimi K3 proves that the technological gap is rapidly evaporating.
Let's look at the sheer scale of this model. Kimi K3 is built on 3 trillion parameters.
Now, the term parameters gets thrown around constantly in tech press, but it's crucial to understand the mechanics of what it actually represents.
Right. Think of a parameter as a synapse in a digital brain. When an AI model is trained on a massive data set like the entire public internet, it adjusts these mathematical weights or parameters to understand the relationships between words, concepts, and logic.
So a model with a few billion parameters might be able to, summarize an email, but a model with 3 trillion parameters possesses a highly advanced neural architecture. It's capable of deeply nuanced reasoning, complex coding, and multi-step problem solving.
And the benchmark tests for Kimi K3 validate that scale. According to the data, it is going toe-to-toe with the absolute top tier of American frontier models.
It's reportedly outperforming Anthropic's older Claude Opus 4.8 model, beating its primary domestic rival, ZAI, and closing the gap significantly on the current state-of-the-art models like OpenAI's GPT 5.6 and Anthropic's Claude Fable 5, specifically in coding and mathematical reasoning tasks.
Achieving that level of capability is a massive technical feat. Training a 3 trillion parameter model requires tens of thousands of specialized GPU microchips running at maximum capacity for months, consuming immense amounts of electricity.
It costs tens, if not hundreds of millions of dollars just in compute costs.
Which is why Moonshot's distribution strategy is absolutely wild. Starting on July 27, 2026, Moonshot is releasing Kimi K3 as an open weight model. Anyone in the world can download it for free.
But we have to clarify the terminology here because open source and open weight are vastly different mechanisms, and the distinction has massive geopolitical implications.
Huge implications. In traditional open source software, a developer releases the final program along with the original source code, the blueprints, and the specific methodology used to build it. Anyone can see exactly how it was made, line by line.
But open weight AI is different.
Very different. Moonshot is releasing the weights, the final, tuned mathematical parameters of the 3 trillion parameter brain. You get the fully functioning, highly intelligent finished product. You can run it locally, you can fine-tune it for your specific business, and you can integrate it into your apps.
But you have no idea what they fed it.
Precisely. You do not get the training data set. You don't know what copyrighted materials, what political biases, or what specific guardrails were included or excluded during its creation. You get the baked cake. But Moonshot keeps the recipe highly classified.
Okay, so the immediate financial question you should be asking is obvious. If Moonshot spent $50 million training this massive digital brain, why are they letting anyone download the weights for free? Where is the revenue model?
The revenue model relies entirely on the mechanics of compute scarcity. A 3 trillion parameter model is incredibly heavy. The file size of the weights alone is massive, but the actual VRAM, the specialized memory required to run it and generate text, is astronomical.
The average developer, startup, or even mid-sized corporation does not have the physical server racks or the specialized silicon required to host Kimi K3 locally.
You essentially need a supercomputer just to turn it on.
Exactly. So Moonshot gives the weights away for free, knowing that 99% of the market cannot actually run it.
Right. And for those users, Moonshot offers API access. You pay a fee to connect your app to Moonshot's massive server farms in China, and they run the model for you. And for that API access, they are charging premium rates, reportedly on par with what Anthropic charges for its Claude Sonnet tier.
So they monetize the hardware constraint.
Yes.
But releasing the weights to the 1% who can run it locally, the massive multinational corporations, the global research labs, and potentially other nation-states, that is a brilliant, highly aggressive strategic move. Moonshot is attempting to commoditize the AI baseline.
If we connect this to the bigger picture, it is a direct assault on the economic moat of American tech giants. Companies like OpenAI and Google have spent billions building their models, expecting to recoup those costs by charging licensing fees to global enterprises.
But if you are a massive telecom company in Europe or a logistics giant in South America and you have your own data centers, why would you pay OpenAI a massive premium when you can simply download Moonshot's 3 trillion parameter model for free and run it yourself?
It aggressively undercuts the pricing power of the U.S. tech sector, and it forces us to look at the geopolitical temperature surrounding this release. The Tech Radar reporting explicitly notes that the United States State Department has accused Moonshot, along with other prominent Chinese AI firms like DeepSeek and Minimax, of AI theft.
And the mechanics of that alleged theft usually involve claims of exfiltrating proprietary training methodologies, or scraping protected data sets, or reverse engineering model architectures through API probing.
It is vital to state clearly here that we are analyzing the ecosystem, not adjudicating international law. We are not verifying or endorsing the U.S. State Department's specific claims of theft against Moonshot. The critical takeaway for our analysis is the sheer fact that these accusations are being leveled at the highest echelons of global diplomacy.
The diplomatic escalation proves the underlying thesis of our entire discussion today. Artificial intelligence is no longer viewed strictly as a commercial software product. It is classified as a fundamental pillar of national security and economic sovereignty.
Just as supply chain logistics dictate military readiness, control over frontier AI models dictates future economic dominance. The friction is identical. It has just moved from the physical to the digital.
It's wild. We've tracked this macro anxiety from Middle Eastern oil fields to defense contractor boardrooms, through medical supply chains, and into the data centers training trillion-parameter AI models.
It feels massive, invisible, and somewhat disconnected from everyday life.
It does. But this anxiety always finds its way to the consumer layer eventually. Which brings us to a mid-July piece from the Tribune Chronicle looking at the Q2 results for Netflix. This is where the trillion-parameter digital brain lands squarely on your living room couch.
Netflix serves as the perfect case study for how global economic pressures force consumer-facing companies to adapt or die. Because if you just read the top-line numbers from their Q2 report, Netflix looks like an unstoppable juggernaut.
Oh, the numbers are undeniably massive. They posted a profit of $3.4 billion, which is a 9% increase over the previous year. Total revenue hit $12.56 billion, a 13% jump.
They successfully executed price hikes without triggering a mass exodus of subscribers, and they continued to add new users globally. By every traditional metric, it was a triumphant quarter.
Yet immediately following the release of these numbers, Netflix's stock plummeted 7.2% in after-hours trading. Billions of dollars in market capitalization were wiped out instantly.
To understand why Wall Street would punish a company that just made $3.4 billion in profit, you have to understand the mechanics of growth expectations. When a company reaches the scale of Netflix, investors no longer care about current profitability.
They only care about the velocity of future expansion.
Exactly. Netflix issued a forecast for Q3 projecting a 12% revenue growth. But the algorithmic trading models and Wall Street analysts had priced in an expectation of 13% growth.
That 1% delta, the slight deceleration in the rate at which they are getting bigger, was enough to trigger a massive sell-off. So what does this all mean? It is the ultimate manifestation of the macroeconomic anxiety we discussed in Section 1. In an environment where capital is tight and interest rates are high, investors are utterly ruthless. You can't just be profitable, you must demonstrate an accelerating trajectory.
It's like a high school student coming home, showing their parents a report card with straight A's, and immediately getting grounded because they admitted they might only get an A- in calculus next semester.
That is the perfect analogy. The past performance is irrelevant, the future deceleration is punished.
And this ruthless market dynamic is what forces Netflix's hand. They are facing a structural ceiling. Market saturation. There are a finite number of households globally with high-speed broadband internet and disposable income.
In core markets like North America and Western Europe, nearly everyone who wants a Netflix account already has one or shares one. You cannot generate 13% quarterly growth purely by finding new humans.
Which means the only path to survival is extracting significantly more value from the humans already inside the ecosystem. The reporting outlines how Netflix is fundamentally altering their product to achieve this.
The first pillar is the aggressive expansion of their ad-supported tier. They are projecting to pull in $3 billion in advertising revenue this year alone. They're essentially converting a subscription model into a hybrid broadcast model.
The second pillar is the pivot into live events, like broadcasting the Women's World Cup. Historically, Netflix's entire value proposition was on-demand viewing, watch what you want when you want.
Right. But live events create appointment viewing, which generates massive concurrent audiences. And that allows Netflix to charge advertisers absolute premium rates for 30-second unskippable spots.
But the third pillar is where the macro technology fully integrates with the consumer experience. To make the advertising model work, you have to keep the user glued to the screen. You have to solve the most persistent, frustrating problem in streaming video: the paradox of choice.
We have all experienced the endless scroll. You open the app, you are presented with thousands of thumbnails, and the sheer volume of choices overwhelms your decision-making capacity. You scroll for 20 minutes, become fatigued, and ultimately close the app to look at your phone.
And for an ad-supported model, that abandoned session is lost revenue.
Historically, Netflix tried to solve this with collaborative filtering algorithms. The math was relatively simple. If user A liked Stranger Things and The Crown, and user B liked Stranger Things, the algorithm would recommend The Crown to user B.
It relied on vast matrices of historical viewing data, but as the library grew into the tens of thousands of titles, that basic matrix factorization stopped working effectively.
So Netflix is deploying the exact same technology we just discussed with Moonshot. Large language models. They are integrating deeply complex AI directly into the search and discovery interface to power natural language intent.
Instead of typing a rigid title or an actor's name into a search bar, a user can interact with the platform conversationally. You can tell the AI, I want a dark British mystery series, but nothing too gory, and it needs to have a satisfying ending.
A traditional search algorithm would break, trying to parse the nuance of not too gory or satisfying ending. But a large language model understands the semantic intent behind those words.
It can instantly parse the metadata, reviews, and internal tagging of the entire Netflix library and surface Harlan Coben's I Will Find You, which the report noted was one of their top streams.
Or a user could say, I want an animated show, but specifically geared toward adults, maybe with some action. And the LLM bypasses the children's section entirely and pushes their new hit Swapped, or the anime K-pop Demon Hunters.
If they want a specific regional flavor, like a Korean drama about revenge, it serves up Teach You a Lesson.
The integration of the LLM transforms the interface from a static catalog into a highly personalized, hyper-efficient concierge.
And this is the crucial synthesis of everything we've analyzed today. Large language models are no longer abstract research projects in a data center, and they aren't just geopolitical weapons used to undercut American tech monopolies.
For a company like Netflix, deploying an LLM is a mandatory fundamental survival mechanism for consumer retention.
They must utilize the absolute edge of frontier technology just to keep users engaged long enough to watch the advertisements that generate the revenue required to keep Wall Street algorithms from tanking their stock price.
The chain reaction is entirely complete. We started at the absolute highest altitude of global systems and followed the friction all the way down to the living room. Let's trace that path one more time to see the whole board.
Yeah, let's recap.
We began with the profound macroeconomic anxiety gripping central banks, the paradox of the US dollar remaining dominant against the euro despite weak domestic inflation.
And we saw that the driving force was geopolitical tension in the Middle East, keeping oil prices near $80, terrifying policymakers with the specter of 1970s-style stagflation.
We watched that geopolitical friction immediately alter the behavior of the organizations closest to it. ASRC Federal elevated Mike Manzo, a pure defense and intelligence operations veteran to CEO.
Because they aren't preparing for peacetime expansion, they are preparing to manage the silent battlefields of IT modernization and fractured global supply chains.
We then saw how those fractured supply chains are bleeding into the civilian sector, taking a massive bite out of Intuitive Surgical. Despite building an impenetrable moat of 11,000 surgical robots, their profit margins are actively being eroded by global tariffs.
A company building the future of medicine is forced to litigate emergency economic warfare acts just to protect the supply lines for their robotic accessories traversing China, Germany, and Mexico. And to shield hospitals from that same inflation, they have to re-engineer their entire sales model into usage-based leases.
From physical hardware, we moved into the borderless software war, witnessing the escalation of the U.S.-China AI arms race. Moonshot's release of a massive 3 trillion parameter open-weight model is a calculated maneuver to commoditize the AI baseline.
Attacking American tech dominance by giving global developers a free, highly capable digital brain, sparking intense diplomatic accusations from the U.S. State Department in the process.
And finally, we landed on your couch watching Netflix deploy those exact same large language models to solve the paradox of choice. They are using frontier AI as a retention mechanism, hyper-personalizing search, just to ensure you stay on the platform long enough to validate their new advertising model and appease a ruthless Wall Street that demands endless growth.
It is a closed loop of cause and effect. But before we finish, there is one final unmentioned scenario that sits at the exact intersection of all these data points. It is a hypothetical that none of these individual sources explicitly warned about, but it is the logical conclusion of the friction we've mapped out today.
I love mapping out the unseen collisions. Walk us through it.
Today, we analyze Netflix spending millions to integrate LLMs into their consumer search interface. And we analyze Moonshot releasing a highly capable 3 trillion parameter open-weight model for free. Right now, in 2026, massive Western consumer companies, whether in streaming, global retail logistics, or financial services, are paying exorbitant API licensing fees to American tech giants like OpenAI, Anthropic, or Google to power their back-end AI infrastructure.
It is a massive line item on their balance sheets.
Exactly. But in an environment of high interest rates and ruthless Wall Street demands for margin expansion, chief financial officers are desperately looking for ways to cut costs. In the near future, what happens when the CFOs of those massive Western consumer companies realize they no longer need to pay that premium?
Wait, you mean?
What happens when they look at the benchmarks of Moonshot's Kimi K3, realize it is just as capable as a U.S. frontier model, and decide to quietly download the open weights for free?
Oh, wow. They swap out the expensive American brain for the free Chinese brain.
Precisely. They host it on their own internal servers, and they use it to process their back-end consumer data, run their logistics routing, and power their customer service algorithms. It would be a completely invisible integration to the end user. You wouldn't know if the AI recommending your next movie or routing your package was trained in San Francisco or Beijing.
The economic implications of that are staggering. It would instantly hollow out the revenue models of the American AI sector.
But the deeper question is the impact on global cybersecurity. If vast amounts of Western consumer and logistical data are being processed through neural networks with completely opaque training origins, what vulnerabilities are being quietly embedded into the system?
That is a terrifying thought.
And most importantly, when the U.S. intelligence community realizes that the open weight strategy has successfully bypassed their economic moats, how will that unseen technological shift exacerbate the exact same geopolitical tensions and macroeconomic anxieties we started this entire discussion with?
That is a brilliant and frankly terrifying architecture to consider, because it proves that when you step back into the world of global macroeconomics and deep technology, you really cannot rely on a simple X-ray.
You can't. The surface level is just an illusion.
You can't just look at the jagged white line of a stock dropping or a currency fluctuating and think you understand the disease. You have to force yourself to look at the murky, invisible tissue connecting the oil fields in the Middle East to the supply chains in Mexico to the server farms in Asia, all the way to the streaming algorithms in your living room.
It's all connected.
It really is. Thank you for joining us on this journey today. Keep questioning the headlines, keep looking for the hidden mechanics driving the math, and we will see you next time for our next deep dive.